Welcome to Exchange Traded Fridays, brought to you by ETF.com. Now, today is going to be a very special episode. We're going to be discussing ETF.com's first ever report, the Global Investor Survey, sponsored by Vanguard. I'm Kristen Myers. I'm the editor-in-chief of ETF.com. And here to dive a little into the findings, we have today wealth management editor Jeff Benjamin and Bill Coleman, Vanguard's head of U.S. ETF capital markets. Jeff, Bill, I am so excited about today's episode, and I'm really excited that you guys are both here to join to discuss it.
Looking forward to it.
Same here. Thanks for having me.
Of course. There's so much that we kind of got from this survey, but before we wanted to jump into the findings, I just wanted to share a little bit about the report. And this is for all the listeners that haven't yet had a chance to read it. And we will be discussing how everyone can kind of go and download that report. Now, we did survey over 600 people. That's both financial advisors and retail investors for the findings that we are about to discuss. Now, of the investors, more than half had a net worth of more than 1 million, and they range in age from 36 and up, more than half of those investors that we surveyed. Now, the majority of financial advisors are bringing over 21 years of experience, and a fifth of the advisors that we surveyed are managing 500 million in assets and more. Now, we asked them a range of questions, from how they feel about the market, to what sectors they're investing in, to what ETFs they want to add to their portfolios in the future. And in this year's report, as you will notice, we dive into one special theme, which is on active ETFs, which we will be discussing a little bit later in this episode. So let's just jump right into it with the market and the sentiment, because we're actually recording this interview at a pretty interesting time. Just as a kind of brief note for everyone, it is actually the day before the presidential election. So we asked both advisors and retail investors how they feel about the market. And it actually, when it comes to politics, it was the number 2 cause of anxiety for advisors moving forward, and the number 1 cause of anxiety for investors. So I'm curious to know how we're sort of feeling that those political fears are really going to be continuing out ahead in the near term after the election is sort of over. Do you still kind of see those anxieties continuing far past, I would say, maybe November, December, Bill?
Presidential elections matter, but not so much when it comes to your investments. We have research here that looks at the performance of a 60-40 stock bond portfolio each year since 1860. And there's no statistical difference between this performance in a presidential election and a non-election year. They're both around 8 to 9%. So what's important to note here is part of successful investing is understanding what you can control and letting your emotions take a back seat to the financial plan you put in place. And, we go back to a saying here a lot, and it's all about time in the market, not timing the market.
Now, it wasn't just politics, though. I mean, they also had some fears, at least when it came to their portfolios. The biggest concern for advisors and the second biggest concern for investors, they kind of flip-flopped on this a little bit, was actually recessionary fears. Now, this is November. We have rate cuts on the table. Rate cuts are going to be expected in 2025. Do you think those recession fears are going to continue? Or again, do you think that's just maybe a snapshot of when we were asking some of these folks some of these questions, which was, to be transparent, August through the start of October?
Yeah, in addition to the presidential election we also have the Fed set to make a decision on rates this upcoming Thursday on November 7th. And, based on where futures are trading right now, it's looking like it's a 98% chance the Fed will cut rates by 25 basis points, with another 25 basis point cut likely in December. So it's, like you said, it's important to note that we're recording this before these decisions are made. So when this podcast is made available, we'll know what the results are. To get to your question, investors are eagerly anticipating further rate cuts from the Fed, largely seen as positive for the stock market and the broader economy. Fears around the economy, like you said, recession concerns, inflation worries are still real. There are still real concerns for many investors, even among the pending cuts. These concerns are only heightened with the presidential election, which can create additional volatility in equity markets. And it's important to note here, During heightened volatility, prices can change quickly and dramatically. Market makers know this. They will naturally widen their spreads on both individual securities and ETFs. So it's important for advisors and individual investors to use sound trading techniques and not let emotions override decisions made for their long-term financial plans.
Hey, Bill, let's get into a little bit of the portfolio management stuff a little bit more with and there's a lot of information in this survey, as you know, but one of the things that came out is that advisors say they plan to add more ETFs to portfolios, but do not plan to change the number of issuers, the ETF issuers they work with. So, what does that say about what advisors are looking for in an ETF?
Oh yeah, so the survey highlights a strong and growing preference for ETFs among advisors, and all the advisors surveyed are invested in ETFs, and I would hope so. It's an ETF.com survey, but most of them are heavily invested, with nearly half of them allocating 50 to 75% of their clients' portfolios in ETFs. Over the past 6 months, 65% of advisors have increased their exposure to ETFs, and 66% plan to further increase this exposure in the next 6 months. And brand matters here. That's something that we're seeing consistently. And this sentiment is supported by the numbers we're seeing in the industry. There's been explosive growth in the number of ETFs available to investors and the number of ETF issuers in the market since the introduction of the ETF rule back in 2019. There are now over 200 ETF issuers and over 3,700 products available to investors. Yet, 75% of the ETF assets are still concentrated among the top 3 ETF issuers.
Well, brand matters. That's almost an understatement. We see that so much in the advisors we talk to and the stories we write. I guess you really can't beat a brand name in the ETF space. There's something else in the report that obviously was very interesting was that advisors have been invested. Well, it shows where advisors have been invested over the past 6 months and where they plan to invest over the next 6 months. A number of takeaways there. But what are some of the things that interest you from that finding?
Yeah, looking at the survey, there weren't any significant sentiment changes for advisors from the last 6 months to the next 6 months. The same asset classes remain top of mind for advisors that are in the top 5. So that's core equities, dividend and income strategies, active, fixed income, and sectors. With core equities and dividend income being the top 2, both past 6 months for future 6 months. Active continues to be of very high interest too, which is where a lot of launch activity has been. Core equities continue to collect a lion's share of the flows, and dividend income remains a focus for advisors. Let's focus on active a little bit. Active has continued to be a storyline of 2024 and an area of interest for investors, as noted by the survey. Through October, there have been over 580 new ETF products launched, shattering records. I think the last record was 493 last year. And over 75% of those launches have been active. Even though active ETFs make up approximately 8% of ETF assets, around 30% of flows have gone into active strategies. So definitely punching above their weight there, which is indicating investors are increasing their appetite for active exposure through the ETF wrapper. Going to core equities, still very strong when it comes to cash flow. 6 of the top ETFs when it comes to terms of year-to-date net flows are core equities, with the top 6 equity products accounting for over 25% of the net ETF flows year-to-date. And, talk about our S&P 500 ETF VOO. It's dominated flows this year, collecting about 20% of all ETF flows, over 85 billion in net flows year-to-date. Switching it up a little bit, fixed income, still of high interest in both periods, which is not surprising. We've been saying that bonds are back, but the prospect of falling rates isn't the only reason. Yield income is higher too. Bonds always play an essential role in a portfolio because it balances out more volatile equities. With coupon payments higher as they are right now, bonds could also withstand some price declines if rates were to rise. Buffer ETFs grown fast over the past couple of years. You see this becoming a growing segment of the market. Important to know here, Vanguard doesn't offer any structured ETFs, any buffered ETFs, but proud to say 100% of our ETFs do have options trading capabilities, options listed on them. So you can you could potentially generate additional yield through a covered call writing strategy. And you could do that with any one of the 86 of our ETF products.
Let's talk about emerging markets. That also was something that stood out in the survey. The increased exposure over the past 6 months, 16% plan to increase exposure over the next 6 months, 21%. With what's going on with China and China's stimulus packages that's going on in that country with their central bank, is there an opportunity there, do you think, in emerging markets?
Yeah, emerging markets have always been a great diversifier in portfolios, and there's certainly been no shortage of news in these particular markets. So I think a lot of investors are seeing this news and seeing emerging markets as an opportunity to add a little bit of diversification in their portfolios. So yeah, definitely some more interest in that sector.
So, Bill, I want to kind of jump back over to a little bit of the retail investors, just because I want to talk about some of the sector-based investing that they'd been doing. Now, when we were looking at it, they seemed most keen on the tech sector. And I'm avoiding saying too much numbers because I know I have a hard time remembering numbers. So I imagine most of our audiences will as well. But at least when it comes to sectors that they were most interested in investing in over the next 6 months, over 53% ranked technology as the number one sector that they want to invest in over the next half a year, which isn't surprising, of course, as we've seen the kind of run that tech has really had. But we've also seen a huge amount of volatility when it comes to the tech sector. So when you're seeing some of these results, I mean, how do you think advisors really should be talking to their clients about this sector, since there has been so many concerns about continued growth in the tech sector, about potential volatility going forward?
Yeah, as you said, the technology sector has seen tremendous growth over the last few years, and it's been a huge driver in the performance of US markets. Just looking at Vanguard's information technology ETF, it's up 21% year to date, 44% over the past year. So, no surprise that people are interested in this sector and want to allocate money there. But it's important that investors focus on diversification and avoid concentration risk within their portfolios. And yeah, this can be difficult to do when the Mag 7 stocks accounted for nearly 60% of the S&P 500 market returns, this year. But at Vanguard, we believe diversification is key to long-term investment success, and clients should try to avoid performance chasing. By diversifying investments across stocks and bonds among sectors, investor can reduce overall portfolio volatility and help guard against large unnecessary losses. So, when considering what mix of investments is appropriate for them, investors should bear in mind the benefit of having a portfolio that matches their level of comfort with the ups and downs of the markets, and diversification is really key there.
Now, when it comes to sort of, again, educating clients, I want to talk about this sort of divergence that we're seeing between the advisors and the retail investors. So retail investors more interested in dividend, income, high yield bond ETFs, while advisors, they really expressed that going forward, they're more interested in active buffer and factor ETFs. Is it just education, do you think, that's causing that divergence? And how can advisors, really get some of their clients interested in some of those other essentially ETF categories?
Yeah, I think there's an ease of use component here. Retail investors can better understand products that have been in the market for a long time, that generate yield the old-fashioned way, through dividends, through interest or coupon payments. So they're very familiar with that, and that's where they've been allocating their money. Advisors, on the other hand, could take the time to be educated on the more innovative solutions available for high-yielding instruments. And advisors have been looking into this, and it's led to a lot of adoption of premium income and flexible income products, as well as factors that provide total return alpha opportunities that may be greater than the traditional means, but also maybe too complex for the average retail investor to try to understand. So this is where advisors have been able to dig into this, learn the products, and recommend them where it's suitable for their clients.
Right. And continuing to dig in a little bit on actives, because we did ask, advisors essentially what they're looking for and what's the, top criteria when they are selecting the ETFs. And we found that they're actually pretty similar, whether it's an active ETF or whether it's an index ETF. And those are going to be performance, fees, and tax efficiency. So naturally, this begs the question, should they prioritize, those same criteria for both active and index ETF? Or are there perhaps maybe other factors that should be more important for actives versus index?
Yeah, absolutely. So performance, fees, and tax efficiency. It's really not surprising to see those three factors featured because they can be the easiest for the client to understand and therefore used to judge the quality of their investment or their advisor. So how the fund is performing is what everyone cares about most when they get their statement. That's what they look at. Clients increasingly understand the impact of fees in reducing compounded returns, which can lead to underperformance. And then tax efficiency is always going to be important for most clients who want to avoid that large tax bill in April. So it's important to note that not only does this thoughtfulness help the client, but it helps the advisor's revenue too, since the accounts are under a wrap fee. The more the client's assets increase, the more of a fee the advisor gets to collect. So having strong performance with low fees and limited assets leaving the account for taxes makes a real difference to the advisor. It's important to note that fees matter for active too. The less an active ETF charges, the more returns the investor keeps and the less risk a manager must take to be a high expense ratio. So if you think about that, if there's a high expense ratio and the active manager wants to outperform their benchmark, that hurdle is just that much higher. So our founder, John Bogle, once said, in investing, you get exactly what you don't pay for. So even if a product has the opportunity to deliver alpha, cost can reduce that return. So bottom line, fees always matter. Active index fees matter. And tax efficiency, it'll be interesting to assess how that looks for active ETFs over time. There's going to be higher turnover in these products, which could lead to less tax efficiency relative to their passive peers. But the in-kind redemption mechanism will almost always, create a more efficient structure in the ETF wrapper than its mutual fund peer.
And looking at, again, just sticking here with active, again, for everyone listening, this is what we dug into in this report. We actually found a little bit of a difference in terms of their preference for active strategies. So we're looking at advisors. They seem to prefer active strategies for emerging markets, 65%, small cap equities at 64%, and high yield bonds at 64% as well. On the flip side, however, they did not have that sort of preference for active strategies when it came to larger mid-cap equities. Treasury and government bonds was at the absolute bottom. They far preferred index ETFs when it came to treasury and government bonds. So why do you think we are seeing that sort of preference for active, for EM, for small caps, for those high yield bond ETFs?
Yeah, it's no surprise that investors prefer active ETFs in emerging markets, high yield, and small cap strategies. These markets tend to be more nuanced and difficult to transact in than other pockets of the equity and fixed income markets. Thus, portfolio managers can take advantage of their market knowledge to help generate more consistent alpha in these market segments compared to others. Versus large cap equities, treasuries, and others tend to be markets that are highly efficient, and there tends to be less of an edge for a portfolio manager to generate alpha outside of traditional active bets.
Hey, Bill, I want to go back to the talk about active strategies and portfolio management. I kind of love this line of thinking that when money moves into active strategies or really anywhere, it has to come from somewhere. And the survey suggests that most of it is coming from existing allocations, specifically active mutual funds and index ETFs. How do ETF issuers like Vanguard use that kind of information to inform their product strategy?
Yeah, you're right. We've seen a steady migration from mutual funds to ETFs over the past few years. And nowhere has that been more evident than in the outflows of active mutual funds with inflows into active ETFs. About 32% of all the cash flow this year has gone into active ETFs. So index funds are still taking in 68% of the flows, which showcases that the assets are not necessarily coming from index ETFs. ETFs are increasingly becoming the vehicle of choice for all different investment strategies, both index and now increasingly active. Clients like the trading flexibility, and in model portfolios, the ETFs allow for more efficient rebalancing by limiting cash drag inherent in the mutual fund rebalancing. 72% of ETFs launched since 2021 have been active, as there are simply not that many easy index ideas left. So got to go to active for the more innovative ideas. Vanguard's lineup has a few gaps on the index side, but we would expect to close those in the next few years. And our eyes are set on active and how we can improve or provide more opportunities for clients to utilize active strategies with Vanguard's famously low costs and strong history of performance. We think we can provide the additional tools a client portfolio needs.
Okay. Suggesting that Vanguard has gaps on the index side, that would be news to me. I'd like to know where you see those gaps. That's I think of Vanguard as kind of having everything. But anyway, there doesn't appear to be a lot of consensus on the way to use active ETFs. And this is what's kind of up out there in the category of, that's what makes a market. There's all kinds of things you can do and different ways to do it. Some will say it'll be, it's active will become the core. Some would say it's a satellite position. Some plan to trade them more frequently than index ETFs. Is there any guidance you can provide financial advisors when they trade active ETFs and build portfolios with them?
Yeah, sure. When trading active ETFs, or any ETFs for that matter, we'd want clients to be thoughtful of the same trading best practice that we talk about with passive ETFs. Use limit orders to protect against adverse movement in the market price. Try to avoid trading in the first 15 minutes of the trading day as price discovery occurs in the market. Be careful around volatile market events like Fed announcements, and get assistance when you're trading in large sizes, either from your custodian's block desk or the high touch desk, or you can reach out to the issuer's ETF capital markets team. Regarding usage in a portfolio, we think that active certainly has a place in a lot of portfolio strategies, but we would encourage clients to understand the fund's strategy and risk profile and be thoughtful of the cost. High expense ratios, wide spreads, and volatile premiums and discounts can quickly erode any alpha that might be produced in an active strategy. So definitely keep in consideration, top of mind, what the costs are of any product that you're looking to invest in.
All right. Well, I know that we could have talked about this, honestly, for another hour. Again, this is a pretty big report that dives into a bunch of different findings, whether it's from the retail side to financial advisors, into active strategies and more. But unfortunately, we can't talk about it all. So that's going to have to be all for this week's episode of Exchange Traded Fridays. Now, as I mentioned, we can only dive into just some of those findings in the Global Investor Survey. So head on over to ETF.com to download the full report. Now, over the coming days, we're going to be publishing more and more analysis on the survey. So be sure to keep your eyes peeled and, of course, keep visiting ETF.com for more. Bill Coleman, Vanguard's head of U.S. ETF capital markets, Jeff Benjamin, wealth management editor for ETF.com. Thank you so much for breaking all of this down for us today.
Of course. Thanks for having me.